Hi students, today we're going to cover derivatives, the option market, futures and stuff like that. It's a very important part of the financial world that we live in, and it's a part that sometimes is referred to as the tail that wags the dog, and the dog in this case is the stock market. And economists watch it as a hawk because it gives them good indications of what we can expect from the near future. See you soon. Take care. Bye. This video will cover derivatives. A derivative is a financial security with a value that is reliant upon or derived from an underlying asset group or a group of assets, a benchmark of some sort. The derivative itself is a contract between two or more parties, and the derivative derives its price from the fluctuation in the underlying asset. The most common underlying assets for derivatives are stocks, bonds, commodities, currencies, interest rates, and market indexes. These assets are commonly purchased through brokerage firms. Derivatives can also be traded over the counter in the so-called OTC market or over an exchange. The OTC derivatives constitute a greater portion of the derivatives market. Derivatives can be used to hedge a position, speculate on the directional movement of an underlying asset, or give leverage to different holdings. The derivative's value comes from the fluctuation of the values of the underlying asset. Derivatives are used for currencies as a way to avoid fluctuation in the underlying currency risk. It could be seen as an insurance policy. What happens in trades will happen in the foreign exchange market where currency futures or currency swaps are entered into contracts. Derivative contracts are very flexible and can be tailored for your needs. Most of the time we will talk about buying a call or buying a put. So we typically look at the buy side, which is the blue boxes indicated here. If you buy a call, you're expecting that the price of the underlying asset will go up. If you buy a put, you're expecting that the price might go down. The buy side of options have the right to exercise, but not the obligation to do that. Assume that the buyer of a call would like to have access to the upward potential of, for example, the stock of Apple. They might not have the money to buy the Apple stock at this point, so they go in and enter a call option contract on the underlying asset of Apple. And if the stock price increases, they could either accept to settle with the cash difference that they just made. Alternatively, they can have the right to buy the underlying stock at a certain price, but then they would have to pay the full value of not only the contract, but also the underlying value of the stock at the negotiated price. In this case, if someone that buys a call, the stock price goes up and they want to exercise, not just settle on the cash difference and get paid in cash, but also want to have the delivery of the underlying assets, the person who sells the call will have to go either buy it in the open market and give it to the buyer of the call, or use their own inventory and give it over that way. The seller of a call or a seller of a put, they have the obligation to pay. So on this side, you have obligations. You do not have the freedom of not fulfilling that obligation. Now, the seller of a call believes that the stock price will go down or maintain flat, and that way they receive from the buyer a premium on that underlying asset. Likewise, on the put, here is slightly different. Assume that someone that owns Apple is afraid that the stock will drop in value and buys insurance. at a certain price to prevent it from going down in value. Now, naturally, the stock can still surpass that bottom that they're willing to have it and drop like a stone, but then they can exercise their put and receive either the cash difference between the negotiated price and the current price of the stock. However, they could also force or put the stocks back to the seller of the put and receive the negotiated price for those stocks. So the seller of a put can be forced to have the obligation to accept delivery of the stock from the buyer of the put, and they put it to the seller, where the call might have to deliver stock to the buyer. Now, the maximum risk for the seller of a call is infinity. In theory, at least, the stock price can go as high as, the moon or higher and beyond. Whereas the risk of selling a put, it can only drop down to zero. And so that way you can actually calculate the full risk, whereas on the call side you can't. The derivatives market is a zero-sum game. That means that there's one winner and one loser. Here's some terminology. In the money means that there's an intrinsic value of the underlying option. That means that you can exercise your option. Either if you have a put option or a call option, you can make money on it. And the buyer of that option makes the money. And it will be paid by whoever sold that option. At the money, however, that's at break even. That means that you're not actually making any money there. So you will probably not exercise that option. However, if you really want to have an asset, for example, a certain stock, then you can actually exercise it even though it's at the money, and ask for delivery of the underlying asset. It's very unusual, but some hedge funds might do it that way to get access to buying large quantity of stocks. Someone that actually has a commodity, for example, might want to get rid of that commodity and will actually, as a owner of a put option, give delivery of the underlying asset. So you can just imagine the surprise when someone that had a bunch of potbellies wanted to put that back to the trader in Chicago and saying, hey, by the way, we have a bunch of semi-trucks outside. It's all yours. Find a refrigerator to put it in. Alternatively, if you have too much oil, like it happened this past spring of 2020, that someone has too much oil and has a put option, and they want to put that oil to someone else because they have no storage space. So how an option is used can be very flexible. Now, totally out of the money means that there's no intrinsic value, and the rational thing is that you don't exercise the option and the seller actually makes the money. The options market, the derivatives markets, is also known as a tail that wags the dog, and the dog in this case is the stock market. Option contracts. An option gives the holder the right, but not the obligation, to buy or sell a given quantity of an asset in the future at prices agreed upon today. A call option gives the holder the right, but not the obligation, to buy a given quantity of some asset at some point in the future at a price that is naturally agreed upon today. A put option, on the other hand, gives the holder the right, but not the obligation to sell a given quantity of some asset at the time in the future at prices agreed upon today. Now, these are all on the side of buying a call versus buying a put. The seller of a put or call, they have the obligation to buy or sell a certain quantity of an asset in the future. They have the inverse of the contract. A big difference between European versus American options is that European options can only be exercised on the expiration date, whereas American options can be exercised at any time up to and including the expiration date. Since American options can be exercised early, that means that American options typically has a little bit more value to it. They're a little bit more expensive to buy. You can buy and sell options typically through your custodial account like TD Ameritrade or Fidelity or Charles Schwab or probably even Robinhood today. Now, when it comes to futures, typically the standard contracts of futures, they typically call it futures then, are traded completely on organized exchanges. They are typically standardized contracts. One size fits all. Now, the forward contract, however, is typically traded by investment banks, and they are actually custom made for the needs of a business. For example, if Ford really needs to figure out how much money they need to actually transfer to another country or transfer back to the United States, they might enter into a forward contract to protect that investment and that cash flow. So the futures is a standardized amount of the underlying asset, where the forward is completely tailor-made by the penny for the clients. Now, futures are typically have a set date. Typically, it's the third Friday of each month. And when it comes to currencies, and this is really what we're talking, currencies and interest rates, it's how it's settled is that it's mark to market, which means that you have an account that is funded and money will be added to that account and money will be withdrawn from that account on a daily basis. So the difference is that it's actually fluctuating on a daily basis. Now, the forward contract, however, that's where the participant buys or sells the contract amount of the underlying assets for the investment bank at the maturity at the forward contractual price. So that way it actually settles only on the exact date as negotiated. As previously said, most option contracts settle on the third Friday of each month. And if a lot of people took the wrong trade, there might be some unusual activity in the market that specific day. So if it's extra volatile on a Friday and you realize it's the third Friday of the month, it might mean that someone took the seriously wrong side of the trade and they're trying to solve their problems and deal with it. Now, when it comes to futures, delivery of the underlying asset is very seldom made. Okay? And if you don't like the event that you see that you took the wrong side of the trade, you were selling the option, you typically reverse your trade by buying the inverse contract that you had. And that way it's plus minus zero. You cancel that out. Okay? So yes, that might mean that you actually lost a little bit of premium there. But at least you don't have to worry about delivering or accepting delivery from someone that's putting it to you or calling that asset. Now, a forward contract, however, that's when the delivery of the underlying asset is actually commonly made. It's actually intended. So how do people make money on all this? Well, the traders make a bid-ask spread plus their commission, and that's how they make money. So they make money by driving volume. And the investment bank, they make money by charging their clients. Now, just like standard options on stocks and bonds and so on, futures contract have the same type of language where you have, when you're in the money, then you are actually making some money on that, if you're the buyer, that is. At the money, that's a break even. Out of the money, you don't have any intrinsic value of the underlying asset. And the at money or out of the money, the seller of the option will actually make the money. Intrinsic value has been created when the cost of the underlying assets, the premium that you pay, the contractual cost, has you have that is covered, plus the underlying value of the asset has gone the right direction, and it has surpassed your break-even point and is making you some sort of value, and that would be your intrinsic value plus your speculative value is your option premium total value. So that is how it works. Here's another picture of how options work. So on this side we are buyers of options, and on this side we are sellers of options. So here we go. We have a contract at a certain price. Here's our premium, and we're out of the money. And once we hit our break even, then we start creating intrinsic value. And the inverse of that is that it looks like this, but the other direction. Is that they're in the money, they are actually making the money on this contract as a seller, but as soon as it hits that break-even point for the buyer, it will start creating an expense here. So as soon as this probably happens and they think that it's going to continue, they probably buy the inverse of what they sold to cancel the two contracts out. Now on the put side, you have the intrinsic value here, and then you have the break-even point here, and you're out of the money, and it looks like the inverse mirror image on the picture for the seller of the put. Let's take a look at Emerson Electric. So here we have the stock price on February 26, 2020. As the open was $41.83, and the high was 42, and the low was 41, and it closed at a certain price here. So let's take a look at call options. This is on the buying side of things. So that means that here is a contract at $40.50, which is fairly close to the adjusted close. So this side right here is in the money already. That's why it's highlighted blue. Now, here's the different strike prices, and you can find this information on Yahoo Finance. Enter the ticker symbol, in this case EMR, and it will actually give you all the information about that stock, but you can also look up the option valuation. What's very interesting, besides looking at the strike price, is looking at the volume and the open interest. Typically, the open interest is reported in the beginning of the trading day, in the morning. So these are everyone that say, hey, this is what we're willing to buy. And here's the contracts that are actually executed. So here you can look at unusual option activity. Someone's willing to buy 101,000 contracts at the price of 45, but actually only 49 contracts have been entered here. So these two parts are very interesting to look at. You look at the volume, what actually happened, and the open interest and who is willing to buy and sell stuff, and the different strike prices here. Now, here you can also look at the cost of the option. You know, in this case, the option price is a penny. Whereas right here, it's you can see that it's $45.50, which is 17 cents lower than the close, which means that is a part of the option price plus. So that is a part of this, but the cost of the actual contract would then be say 17, roughly 60, 70, what do I say, 60 cents or something like that. And here's 32 cents because it's above there. So there you can see the prices. They're typically more expensive once you are in the money, and then they decrease. Now let's take a look at puts. Here we're looking at the opposite, where people are quoting from 41.50 where it closed down to 36. Same thing, you have the cost of it, and then you have the open the volume that is actually being exercised, and open interest. Now, the interesting part here is that it seems like there's a lot more people that are interested in buying the options versus buying puts. So buying calls is more popular than buying puts. So if you look at this open interest here for buying puts, there's less people interested compared to buying calls. So it's probably safe to say that a lot of people are betting on that this stock will continue to increase in value. Little did these people know that in a few short weeks we will have a pandemic that would cause the stock price to drop like a stone. And so probably there was a lot of people getting nervous when they were buying stuff right here, and they lost out on their trade. Now, for the seller of an option, time is their friend, and it's called time decay. That's how much money the closer you get to expiration date right here, the more likely you are that you will not need to exercise that option, or someone won't exercise that option, and you won't need to either put receive a put option against you where you have to take in custody of someone's underlying assets, or give up an underlying asset. So time is their friend. So looking at 120 days, 90, 60, 30, 0, the value of that option will decrease the closer you get to expiration, especially if that underlying asset has not moved during the time period. So naturally you're going to wonder, how do I make money on this stuff? Well, there are lots of different strategies, okay? So here's a list of it. You can study it and enter into it once you feel comfortable in dealing with options. So here we have a scale of volatility, okay? Low volatility, high volatility. And here we have underlying security valuation. It's under, fair, or over. So you can look at these different strategies and see what it makes sense to enter depending on how the market looks like. So very often the people that engage in option contracts, they buy different types of contracts. Okay, they might have a spread in between to leverage their abilities to make money. Now, for example, a put spread is an option spread strategy that is created when the equal number of put options are bought and sold simultaneously. The long straddle, also known as a bi-straddle or a simple straddle, is a neutral strategy in options trading that involves simultaneously buying of a put and a call of the same underlying stock with the strike price and the expiration date. Okay, that means that they believe it's going to just hover around there. Another part would be a call spread. Is an option spread strategy that is created when an equal number of calls and options and puts are bought and sold simultaneously. A butterfly, on the other hand, is profited from a long butterfly spread position. The spread is created by buying a call with a relatively low strike price, buying a call with a relatively high strike price, and shorting the two calls with a strike in between. Now, all of this sounds really weird and really crazy, but once you start looking at a stock chart, you will probably see how the volatility of a stock makes sense in doing these, entering into these contracts.
Dear students, I hope you enjoyed this video. If you did, give me and like the page. That way all of these followers like you will get the latest and greatest of my uploads. Not only that, at some point you can help me help you by having a much nicer URL instead of having that really weird one that you can't really remember anyway. So if you do that, I will be really, really thankful, and I'm here for you, okay? So help me help you do better in life. Thank you very much.